Okay, I think we're live. The welcome to the first talk I've done in 2021. Had a few presentations with some of the clubs in the last week or so. We're talking today about the current market situation, and it's a little bit ill-defined. We're just going to go through the market brief now. 2021 is the year of the ox. So from the Chinese calendar, year of the ox is it's a metal ox. It's a year of good finances and hard work. Metals associated with metal objects, traditionally swords, armor and boats. So interesting to see what this year brings after 2020. It's all been very interesting so far. So we're going to talk about the direction of the year, the 7-year cycles, which I always have a bit of a talk about, C19 recovery, electoral years. This is the first year for Biden in the US, Chinese New Year and gold, what's wrong with our market, institutional insurance, and then at the very end I'll talk a little bit about trading tigers, which has been very successful last year over the COVID period and has started off very well this year. The direction of the year. The old saying, up in January, up for the year, down in January, down for the year. You go back to 1980 and it's a very effective guide to the overall direction of the year all the way through to about September, just before October. And the way it's worked is the last options Thursday in December versus the last options Thursday in January. If the two, if the restock is higher than the destock, they destock, institutions destock a bit in December, and then if they restock at a higher level, that sets a bullish pace for the year. If the level in December, the destock level, is higher than the restock level in January, where the market recommences at the very end of January going into February, then that's generally a down year. And it's very broad, but it tends to be very accurate at about the 80 to 90% level. And you can go all the way back to 1980 to have a look at that. Unfortunately, that's always normally very exciting to start the year. This year, I have never seen this before, and I went all the way back to 1980 just to make sure. It's never happened before, which says something about 2021, doesn't it? The last options Thursday in December to the last options Thursday in January has almost no fall in it whatsoever, or rise. It's the open of the day on the last options Thursday in January was higher than the close by a few points, but the market fell all day, and so it closed lower than the options Thursday in December. This is a barometer style guide to the weather coming up, and it really tells us nothing. You could interpret it as slightly higher, or you could interpret it as slightly lower. I choose to interpret it as flat, and the market is treating this as a very flat time, and this is likely to oscillate all the way through to September this year. So 4 times out of 5 in the last 41 years, this has been an accurate signal. This year, it's not giving us a signal, and that's the only time in 41 years that we've got a zero signal from this. C19, is it over? The answer is yes. She's all over Red Rover, and we have a historical model for it. The avian flu, H5N1, became a pandemic in the 2002-2003 period and had a high mortality rate. It's interesting to note, while we're thinking about vaccines and all that sort of stuff, that avian flu and SARS, which is the 2003 breakout, has never had a vaccine or a cure, and they've been working on it since 2003. They call this COVID SARS-2, and so they've magically got an immunisation shot for SARS-2, but they still got nothing for SARS. It's interesting. However, what happened in SARS was that on one day, no one got cured, no one got vaccinated, no one got anything, but the media decided that it was over. And it ended on one day, and the market just went from that point. We'll have a look at this because it creates an interesting model for last year. So here's SARS in the 28th of the 1st, 2001. They said, here's the SARS outbreak in Hong Kong. The market plummeted down. On the 14th of the 3rd, it got to the bottom, and then it climbed up very quickly and then progressed. And if you measure that angle there, that's exactly 33 degrees on this scale, on the index linear scale. And the market literally pressed up at 30 degrees from there in recovery and never actually went back, as you can see. And that's the entire of the 2003 run. It's interesting because of the profile being so very similar. There's the 24th of the 2nd was where the market started to fall because of COVID. On the 23rd of March, it reached a low and it never went back there again. We went into oversold. We had a quick recovery of 3 days, the same as SARS in 2003. And then we've literally proceeded north at 33 degrees. So the similarities of the two are good enough to take on board. Now, the what's happening with the institutions is that they've stopped reacting to SARS. And somebody just said Melbourne has gone into lockdown again today, and the market's a little bit off, but the market has ceased since December in responding to lockdowns, whereas in July, August and September, you know, Melbourne being locked down and Sydney getting a lockdown and everything, saw our market take a significant step back. But after that, in December and January, lockdowns aren't having any effect at all on the marketplace. In other words, the media is not hyping it, and as far as the market's concerned, the low in March 20 is the low, and our market's not going to crash on COVID information again. So away we go. The market's going to continue up, so relatively bullish. There's been some cultural changes with COVID, and some things I expected and talked about last year, and some things I never expected. City living, units and condominiums have plummeted, and the value of inner city living now is very low and still falling. However, residential living has suddenly become a premium. Now, this has particularly hit Queensland, and we're getting international buyers on, up and down the coast of northern New South Wales and Queensland coming in and buying property sight unseen, and we've got Victorian and South Australian and to a lesser extent New South Wales people just buying sight unseen, creating an extraordinarily bullish market in the Australian market, where the Gold Coast, the North Coast, the Sunshine Coast, and northern New South Wales in the coastal areas have experienced 25 and 30% growth in house sales in the last 6 months. And that's not showing any sign of abating at the moment. Private transport, another unexpected side effect. Private transport, having a second car or a third car, has suddenly become very popular, and so car sales have gone through the roof, and that's affected stocks like Eagers and that have done very, very well in COVID. Interestingly, the release of superannuation to help people go through COVID, allowing them to access $10,000 before June and $10,000 after June in that period, has shown statistically that a lot of people went out and bought motor vehicles with that. Public transport and infrastructure is down. It's moved away because of close environment with COVID, and it's not showing signs of recovery at the moment. Large retail shopping centres have taken a dive, and just getting a report from London a couple of days ago that retail centres there have dropped to zero in value. So retail centres that were valued at 200 million are coming back valued currently at around 20 million. We haven't seen that sort of drop here, but we have seen a lot of empty retail space in high density areas. Interestingly, low density shopping, so little 7-Eleven areas and little local community shops, have prospered in this environment, and people are choosing to go to low density shopping areas and moving away from high density shopping areas. It's left stocks like Westfield and that in significant problems, and at the moment they're spending a lot of time not dropping rents to try and maintain profit per meter, but ultimately they're going to have to do profit warnings and look at the circumstances of that. Technology has gone up massively, of course, and anything with communication and home entertainment is gone through the roof. So we're not expecting city living to actually come back. It's units and condominiums are a depreciating asset in high density areas at the moment, and there's no sign that that's going to change. Talk about the 7-year cycles. The 7-year Tiger cycle is 3 years of oscillating growth, 3 years of capital growth, and 1 year of reset. We're in a 5-6 year, and we've just crossed into the 6th year, and so we're expecting an upward market overall in this year. So COVID has upset the 7-year cycle a bit. It didn't conform with our overall 7-year cycles, but by October this year we should be trading reasonably higher than our October figure last year, and I don't think we're going to have any problems with that as we sit here. The October 2022 period is going to be our reset cycle, and that will be very interesting to see how we reset from this. Now, first year presidential terms. Traditionally, regardless of Democrat or Republican, the market for the first year of the new term of presidency, the market goes in one direction, and that's up. We're talking about the S&P 500. So at the moment, we can see that on the chart we've got the little arrow. That's the election, and here's the inauguration over here. Election, inauguration, election, inauguration. I've just showed you 4 so that we've got a reasonable scale to the screen. If you go back to 1988, only one of those actually went down, and all the rest of them, so 1 out of 9 have gone down, 8 out of 9 of them have produced a market that has gone up into the following October. Now, 7-year cycles also base it on October to October on a lunar cycle, and this is also corresponding to that 7-year cycle, not January to December, but October to October. So here we're looking at a run again for the S&P 500 to October. Now, if you think about it, Biden's working on stimulus packages. The Federal Reserve is in a quantitative easing. They've said that they're looking at no interest rate rises this year. We'll address that later on in the talk, and we can see that the pattern overall is go long on the S&P. The election inauguration for 2021 is looking, there's the election, there's the inauguration, and we've got exactly the same profile as we had for 8 of the other 9 elections. Now, it doesn't reference previous presidential elections because previously to 1987-88, the elections were held in March, and so they don't exactly correspond, and we can't fit them as easily. But if you look at it, the tendency, even when they're in March instead of October, is that if you go back through to the early 1900s, most first-year presidential runs are an up market for Wall Street. Talk about gold for a second. Now this talk here is just slightly late for the gold. We expect gold to rise into Chinese New Year, and of the last 30 years it's risen 23 times into the Chinese New Year, and it normally runs more than $25 for the run. So Trading Tigers joined the gold market at the beginning of the week on Monday, and we targeted $25, and we're out on the Tuesday. It was all over Red Rover, and a highly successful trade. So gold is seasonal, and the very next thing that tends to happen after the Chinese New Year is the gold backs off. Now at the moment, gold has already started to back off this morning, and it's back down towards $18.20 an ounce. Our overall look at gold is it's heading back towards 1700. Now that will disappoint some people. I know I speak to a fair few people, particularly in the investment zone, who are saying, oh, gold is the big thing and it's going to go through 2000, but I'm not seeing it for this year. Just have a look at the gold chart. So if we look at the long-term gold chart, we can see that the gold is in a downtrend and has been for a while, and is heading back towards 1700. Now we'll just have a look at some of the fundamental engines in a very general sense driving this. The QE in US is flat chat, so they're printing money very quickly to make sure the US dollar has an inflationary trend but is going down in world value. The Chinese yuan is desperate to keep pace without QE. They're trying to keep pace with the US dollar and hold their relationship at 6 to 1, 6 yuan to $1. As the value of the US dollar falls, what China is doing is selling gold. They use gold to balance their yuan value, and they're selling physical gold in the gold market to bring the gold price down. And we're not talking 100 ounces or 1,000 ounces. They're selling metric tons of gold over the last 12 months to keep the yuan in pace with the quantitative easing and make sure the US dollar doesn't drop below that 6 yuan to a dollar ratio. In the meantime, the US dollar going down has an inflationary trend on gold because it's measured in US dollars an ounce. So the consequence of that is, if the value of the US dollar goes down, the value of gold in US dollars goes up, directly proportional. So it's a very complex equation that you've got. Then we take low interest rates. Now, low interest rates, I've heard many people say that low interest rates drive the gold up. But if you look at the chart over time, low interest rates are a deflationary trend for China, and history doesn't lie. It might not apply in 2021, 2022, but certainly if you look at the comparison of charts, then low interest rates correspond to low gold prices, and high interest rates correspond to high gold prices. Now this whole chart here is very simplistic. We're using Heikin Ashi charts here. We can see that Heikin Ashi is currently in downtrend. This is a couple of days old, this chart, and we can see a solid downtrend going back towards support at 1700. This will all change if there's an issue in Taiwan or an issue in the South China Sea, and we see China increasing or escalating its antagonism of Taiwan, and it'll be very interesting because the US has said that it will act militarily if there's any sort of encroachment on Taiwan sovereign territory, etc. And the Minister for Foreign Affairs in China, or his whatever you call his position, came out the other day in the end of January and said that it's none of US's business, and if it's military conflict they want, it's military conflict they can have. So the Chinese are becoming more aggressive in the South China Sea conflict, and even Australia with its new defence pact with Japan, creating some friction there. Is the Chinese-Australian trade war going to calm down? In my opinion, no, it's going to escalate. So we'll become less and less dependent on Chinese goods, and China will become less and less a market to us in the next 2 years. Copper. Now, this is just to show you the overall direction of copper. Now, that's a very long chart going back all the way to 2008, right? And copper is the first commodity to recover. It's unlike gold and silver that have a lot of currency speculation and tie-ups with foreign investment. Copper is the primary driver of commodity prices. So copper up, iron up, nickel up, etc., etc. We can see copper's up through $3.50. That's very good price for copper. And we can see for the first time in 10 years, it's heading towards $4. That means overall, copper is bullish. Overall, commodities are bullish. So they're increasing. Now, our market at the moment is caught between a rock and a hard place. The rock is the S&P 500. There's only one direction that the S&P 500 can really go, and that's up. They're printing money in the US. One of the key ways to keep it non-inflationary is to put it into the stock market. And so consequently, we saw in QE1, QE2, QE3, we saw the stock market shoot up, shoot up, shoot up. We're pushing an all-time high now. The Treasury, the Federal Reserve over there is printing money at 100 miles an hour and financing the COVID support package, etc., etc. There's only one way for the S&P to go this year, that's up. That'll fulfill the prophecy that the first presidential year of any Republican or Democrat is an up year, and so consequently go long the S&P. If you're not doing anything else, you can just take a position in the index and run the S&P 500 and go long and win. It's really a no-brainer. In the middle of that, between the rock and the hard place, so the rock's the S&P, our market's in the middle of it, and our overall direction is sideways. That's indicated once again by the direction of the year. We've got some problems because we've got stocks, BHP, Rio, Ansell, etc., Westpac Bank, listed on the US exchanges. And so they're benefiting from yield, offering yield and having capital growth as well. In the meantime, they're caught in the Australian market where we don't have the coronavirus stimulus. We don't have, we've got QE, but not to the point where it's going into the stock market. And we're looking for some form of recovery. There's the high there, and we can see it's going sideways. Now here's the UK market, and at the moment the UK, here's the hard place. The UK is going down, and it's quite clearly going down. It's got trouble with Brexit, it's got trouble with C-19, it's got trouble with vaccines, it's got trouble coming left, right and centre. The European Union has rejected the Brexit terms, and they're back to struggling again. So consequently, we've got BHP, Rio, and if we simplify this entire, we don't have to go through all the stocks, because ANZ's got tie-up with Bank of Scotland over there, which has got serious problems, etc. But if we just go BHP is nice and simple. In US, BHP is rising. In Australia, BHP is rising in the morning and falling in the afternoon. In BHP in London, it's opening and falling, and then goes back up internationally. London market's closing, New York market is opening, BHP's going down, BHP's going up, and we're left with BHP being neutralized constantly with a close down, start up, close down, start up, close down, start up, close down. And that's what we're seeing in our entire top 200 at the moment. We've seen that 6,800 for the share price index future, SPY, has been a barrier and it's not breaking that. One of the things powering that, which is very interesting, is institutional insurance. Now, I've gone back quite a ways. I've just showed you here, because we publish institutional insurance in our trading workbook every day. If you go back, the average of institutional insurance all the way back to 2000, June 2000, when we started tracking it, the average is about 50% for the first week of February. And you can see there's 2019, 2018, 2017. And we can see that's where institutional insurance is moderately bullish, okay? Certainly not defensive. In 2019, they were very concerned and they were running institutional insurance at nearly 90%, right? So 10% upside, 90% downside. However, in institutional insurance for all of February and the end of January has been over 100%. I've never seen it before for February, and I've checked, we've only got history back to 2000. There's never been a February that's carried 100% insurance in the entire history of our market. The institutions are tactical. They'll take the insurance off in the morning, buy a few stocks, put the insurance back on, and completely insure for downside risk. Makes it very hard for our market to go up. Once again, we've got this down force in the marketplace. Any adverse move goes a long way, any rise goes a short way. Now that we're not sure why the institutions are so bearish, and I've spoken to a number of people in the industry and everybody's scared, but nobody knows what they're scared of. It's certainly something's coming up. We're seeing Commonwealth Bank the other morning giving a profit warning. We're starting to see some of the big yield stocks say, we prospered during COVID, but the yield is not going to be there. And we're seeing stocks dropping their yield. That could be an overall trend. In just talking about interest rates, the World Bank once again has targeted 0% for 2022 and says all major Western economies should be aiming for 0% interest, and we can see that Japan, Switzerland, Sweden, and the European Union are all at 0%. Bank of Israel at 0.1%, Bank of England 0.1%, RBA Australia 0.1%, US Federal Reserve 0.25%. In the meantime, the Chinese bank, the People's Bank of China, is currently 3.85% and dropping. So it'll be interesting to see. Certainly no value in putting money into the bank at the moment. Now, if we have a look, global financial climate changes, and we had this, I used this frame last year, we've just modified it a bit. Average yield for property, 3%, and capital growth in 2019 was minus 7.8%. Capital growth across the eastern seaboard in the suburban areas is 6.8%. But as I said, that's sort of balanced out by Queensland, Northern New South Wales flying up, 20% plus, and that sort of dragged up the national average. So some areas are experiencing no growth and some areas are experiencing huge growth. The 90-day bills, retail banking returns on $1 million are sub 1%, and I heard a fellow the other day say he's got $1 million capital guaranteed, because some of your big deposits aren't capital guaranteed. He's got his interest capital guaranteed at 0.25%. So not much yield there. And we've got average yield in the share market 4.4% over the top 200. And having a look at the market, There's 180 stocks in the All Ordinaries Index that currently are quoting a yield greater than 5%. So money ultimately has to come into this. Now, Queensland, Northern New South Wales is going to have a better growth this year than the stock market. But if you're talking about, Victoria, City Victoria and City New South Wales and City Adelaide, you're going to be seeing a negative growth over here. And so this is once again going to be an attractor. Even if it stays flat at, say, 6,800, 6,900, or 7,000, we can say, then you get a very small amount of capital growth, but you'll still get some yield out of it. And that's an attractor for major investors. That's the end of the talk. Now, I just go over Trading Tigers for a little bit. And if you've already a Trading Tiger or you know about Trading Tigers, you can turn off now. Trading Tigers looks at seasonal events in the marketplace, and it profiles the individual stocks or the individual instruments that we're trading, and then uses what we say is literally cultural references to rising markets. Are people happy around a time? Are people sad about a time? Are they defensive or are they aggressive? Are they greedy or are they fearful? And this has proved once again in 2019, our fear trades were very strong, but then our greed trades were also very strong. We experienced this in 2009, where you've got strong emotions running in the GFC, and that was one of our best years, where we had 13 people who signed saying they started with less than $100,000 and ended with more than $1 million in the 18th month period of the GFC. Tigers again is in an environment of volatility that's highly beneficial for Tigers, and we take part in seasonal trades that are likely to happen. So if you think about the psychology of the market, coming into Easter, the market will be fearful of that 4-day gap, and so we will go defensive into Easter. If you think about Chinese New Year, gold is a major component of their culture, and so gold rallies into Chinese New Year most of the time. As I said, Tigers have already done this trade. It's a bit late, but after it rallies, right, it's eased off a bit today, so the downside is not that exciting. But if we had stayed at a high around about the 1860, 1875 mark, then we would be automatically going short this afternoon or tonight for the rundown. As it stands at the moment, we think the rundown's probably going to deliver less than $15, so we're not actually pursuing it for Tigers, the downside run. There's more than 40 of these trades every year. You can contact the office, 1300 132 999, or go to the website and have a look at the results. Trading Tigers has been around for a long time now, and we continue to have significant success. Last year was a very successful year for Tigers. We're expecting this year to be a very successful year for Tigers. If you think about Tigers in terms of share price index points, we're up about 60% for this year starting in January. So that's where we're sitting at the moment. If you've done all the Tigers trades as specified, and what I do is I don't tell you what to do. I'm telling you what I'm going to do, and I do the exact trade that I say I'm going to do at the exact strength that I say I'm going to do, how many contracts and everything, and I give you my stops and my limits for the trade, and then I publish my results on those published trades. And this has been a sensational start to this year. We're normally hoping to be about 10 or 15% up on working capital by the second week of February. We're currently 60% up, so there'll be ups and downs for the year, that's a certainty, but this is actually looking to be another good year. As it was before, the first presidential year, if you go back, has given us very strong Trading Tigers results all the way back to 2000. And it's just the nature of the market with the S&P rolling up and our market trying to catch up. It creates unique trades, and one of them, if you want to consider it, you can do the numbers. Tigers are going to enter into an arbitrage trade between the strong and the weak, and the weak one at the moment is not so much our market but the UK market, and we'll be going long on the S&P and ensuring it on the other side with a short on the UK market. And what we're expecting is the UK market to continue sideways down and the US market to continue sideways up, and so that will be an ever expanding growth of profit and if something happens and the market drops, the UK market's expected to fall more than the US market. If the market something exciting and the market goes up, the US market is expected to rise more than the UK market. That's an exciting trade for Tigers coming up, and we might do another one of these next week, and I might we'll have Tigers in that trade. I might explain how the mechanics of that trade to you. Any questions? If you're wanting to join Trading Tigers, contact Investor Centre. And the other thing is we use City Index, the AT Pro platform, and so all our trades are based on returns from the AT Pro platform and City Index. If you don't have one of those, it's fairly important to get one, and it's fairly important as a Tiger to be registered with City Index, because on the 29th of March this year we've got the biggest change in the history of derivatives coming, and ASIC is limiting leverage for all derivative products, and you want to either have access to a high leverage product or be a Trading Tiger and be trading the index. Our leverage, the leverage that we use, will continue for Trading Tigers as an agreement with City Index. So if you're trading derivatives and you don't have a City Index contract and you're not with Investor Centre, give Investor Centre a call, speak to Trish and see what you can arrange. Thank you for listening. See you next time.